The following podcast was recorded on Wednesday, October 18th, 2023, featuring Jim Bianco of Bianco Research. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or biancoresearch.com, or email Gus Handler at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Jim Bianco of Bianco Research. Welcome, Jim.
Thanks for having me.
Today, Jim discusses why everyone remains bond bullish and what they might be missing. Jim, bond bullishness is as strong as ever. What are your thoughts?
Yep, that is correct. It is the strongest ever. Now, I know this tends to be a bit of a argued topic, so let me run you through a couple of charts why I say that. So we're recording on October 18th, and if we go to the first slide, the day before we're recording, Bank of America put out their global fund manager survey. 56% of their fund managers think the next 100 basis point move in yields will be lower. Now, 56 doesn't sound like a lot, but if you look at the chart and if you look at what it says on the right, this is the highest it's ever been in 20 years of surveying this question. So the most people have been bullish by this metric is right now that they are all thinking that the next big move in interest rates will be down, not up. It's not just them. If we go to the next chart, this is JP Morgan. JP Morgan does a weekly survey of their clients. The bottom panel, which is referred to as figure 4, took this right from JP Morgan. Are you more likely to increase or decrease bond portfolio duration over the next year? So this shows you the percentage that will decrease or shorten duration or get into a bond defensive position, only 20%. The other 80% are planning on increasing their duration as their next move or getting into a bond bullish position. So that they are just like the B of A surveyed crowd, which is B of A's global fund managers. This is domestic fixed income managers. Everybody, as I like to joke, is staring at the ceiling saying the next big move is going to be lower in rates and I have to be positioned for it. But if we go to the final chart, this shows TLT. So this is the iShares BlackRock 20+ year treasury. Now, I indexed it back to August 4th of 2020, and it shows that through yesterday, this ETF, that's the top panel, is down 46.8%, roughly lost half its value. The bottom panel shows you the cumulative flows into this ETF. $35 billion has come into this ETF while it was losing half of its value. Two things about that. One, Bloomberg estimates about $10 to $15 billion of money has been lost in this instrument, gone to money heaven, if you want to put it that way. And interestingly, TLT ranks as the second biggest inflow of any ETF out there. Number one is VOO, which is the Vanguard S&P 500 index. Why Vanguard? Because they market this more towards 401k programs and internal employee savings plans, and so they constantly get a flow into that. SPY, which is essentially the same thing, is more of a trading vehicle, so money goes in and out of that. Number two is TLT, and number two is everybody is plowing into an instrument that has lost half its value. So if you look at B of A, you look at JP Morgan, you look at the TLT flows, you have to throw in, we talk about the commitment of traders, the options volume. Everything says that everybody looks at the bond market and concludes you have to be long the bond market because the next big move in rates will be down. Of course, the problem with that is rates have been going up all year. As we record, we are at the highest level in 16 years again today. It has been meting out tremendous pain to everybody who's been trying to buy the bond market, waiting for a rally.
So Jim, why the bullishness?
That's a very good question, why the bullishness? And I think the next slide will go in and tell us at least some of it. So let's go back 1 year ago yesterday. 1 year ago yesterday, forecast for U.S. This is from Bloomberg. Forecast for U.S. recession within 1 year, within a year, hits 100% in a blow to Biden, and they had to put the political aspects of it in there. U.S. recession is effectively certain in the next 12 months in a new Bloomberg economics model projection. The latest for recession probabilities by Bloomberg economists forecast a higher recession probability across all time frames, with 12-month estimate of a downturn by October of 2023, this month, hitting 100%. Not 99, not 98. This is a certainty. A year ago, we were going to have a recession. Now, obviously, we're not. Yesterday, we've got, the day before we're recording, we got a gigantic retail sales number and the Atlanta Fed GDP, and we're only about 10 days away from GDP coming out, is at 5.4%. Okay, could it be off? Sure, but it might be 4. It might not, it's not gonna be 1 or negative. It's never off by that much. So we're looking at a tremendously strong economy. What did they get wrong a year ago that they thought it was a certainty that we were gonna have a recession? Let me go to the next chart. What they got wrong was the yield curve inverted. And they thought that the yield curve inversion was going to work its charm and that it was going to lead to a recession, that it was presaging tighter financial conditions, that companies were going to be hurt by this. If we go to the next chart, the other thing that they were forecasting too was inflation is dead. So this chart, the black line on this chart is actual inflation. All those colored lines in this chart are the forecasts. 70 economists asked, what is your inflation forecast for the next 6 quarters? This is the median. Every single one of those lines goes back to 2%. Even when we were on our way to 9% inflation, they were all going back to 2. They're now convinced inflation is dead. The economy can't handle higher interest rates. The yield curve is inverted. 100% chance we're going to have a recession. And we haven't had a recession. And the economy has stayed very strong during this period. And this is really what has really thrown them for a loop. But they're not backing off of this. They're still thinking, and I'm talking about they being the wider consensus, is still thinking, yes, but that recession is just around the corner yet again. It will occur in the first half of 2024. It will occur in the middle of 2024. And it's the same things. The belief that inflation is dead, the belief that the interest rates are hurting, and the like as well.
So what are they getting wrong?
So if we go to the next chart, I'll start off by saying the first thing I think they're getting wrong is that fancy word I've been using on this podcast and other places. This is a post-pandemic economy. We are not going back to 2019 or 2009 to 2020, and I'll explain that in a minute. This is an economy that is different. And I've said this before, different is not dystopian. Don't think because I said it's different means it's worse. In a lot of ways, it's not. You could argue work from home is not necessarily worse than having to go to the office every day of the week, trudging on a commuter line to a major city center or something like that. Some people would think that their life has been improved because they get a couple of days at home. Others don't. But it is different. And because it's different, the economy needs to be restructured. The labor force is far different than we've ever seen. Deglobalization seems to be a real thing. Using energy as a political weapon, see Russia, see Saudi Arabia with their voluntary cuts, means that there are more frictions and imbalances in the economy, which I believe, A, is going to hold the inflation rate higher than people think. We are not going back to 2%. I've argued that on a year-over-year basis, the low of inflation was June, and we're on our way back up from the June low in inflation. And so that we are not going to see that continued glide path to 2%. We're going to see that we're stuck at something like 3. Now that shows up in this chart. The orange line in this chart is the 10-year yield. The blue line on this chart is year-over-year changes in nominal GDP. What's nominal GDP? That is in real growth plus inflation. If you asked me or anybody else, what is the appropriate level of interest rates for an economy? Should they be 10% or 20%? Should they be 0? Should they be 5, 8? Where should they be? how fast is that economy growing? If that economy is on a nominal basis growing at 10%, then they should have interest rates somewhere near 10%. If they're growing near zero, like Japan, they should then have interest rates near zero, or like Japan was, they're picking up a little bit. If their nominal GDP is 200%, who has 200%? Venezuela does, because 199%, or maybe more specifically 205% of the 200% is inflation and -5 is real growth, then their interest rate should be 200%. So if you look at the nominal GDP numbers on our chart, now there's a big dip down and a dip up because we shut down the economy and we restarted it. But if you get past that noise around 2020, you'll see that nominal growth is still somewhere around 6%. That is much higher than we've seen in previous decades. If we are going to have higher inflation and we're going to continue to have, let's call it no landing, no recession, the economy keeps going, Atlantic GDP at 5%, all right, maybe it's overstated, let's call it 4%, we're going to continue to print 5 or 6% nominal GDP. And if that is what we are, that suggests that interest rates should jump to somewhere between 5 and 6%. Now, there's a problem people have in trying to get to this. So if we jump to the next chart, the next chart shows you kind of a popular thing you hear a lot of people talk about. This is real interest rates. What are real interest rates? These are interest rates after inflation. TIPS, the Treasury Inflation Protected Security. If you buy a TIPS security, you get an interest rate. Earlier today, when I updated this chart, that interest rate was 2.45%. But you also get the inflation rate. They give you more bonds. You buy $100 worth of these bonds, and the inflation rate, and you get 2.45% interest. If the inflation rate is 4% in a year, you have $104 worth of these bonds, and you get 2.45% interest on those $104 as well. They refer to that as accretion. I used to joke that I thought I had to go see a doctor for accretion, but now I have to go see a bond salesman about my about accretion as well too. And so this number of these real rates is at the highest level we've seen since 2008. Oh my God, it's at a high level. It's at a 15-year high. It's overdone. It's going to hurt the economy. It has to come down. This is the argument you hear all the time. But what I would argue is that 2009 to 2020 period, that was the QE period. That was the abnormal period of abnormally low real rates, not what we're seeing now. So if you jump to the next chart, the blue line on this chart is those same real rates from TIPS. They only go back to 1997. That's when we started trading TIPS. So I took actual real rates. What I did there is I took the 10-year yield minus the inflation rate, year-over-year CPI, and ran that back to 1962. And if you look over on the left on the chart, what is the average since 1962? 2%. Where are we now? We're 245, 230, somewhere in that range. We're in somewhere in that range on real rates. Okay, they're up, but they're only back to their 50 or 60-year average. It's that period from 2009 to 2020, that was the abnormal period. So when people look at these rates and they say they're really high, they're at a 15-year high, yes, because the previous 13 years was manipulated too low through money printing, through quantitative easing. The final chart I would show you is this is term premium. Now, what is term premium? Term premium is not observable. It's not something that you can go and say, show me the ticker symbol for term premium. Technically one exists, but that's only because Adrian, Crump, and Moich, which are 3 economists at the New York Fed, put together a model to try and estimate it, and that is published as a ticker on Bloomberg, which is where I got this data from. Term premium is the amount of compensation you should get for taking extra risk because of maturity. That's a fancy way of saying a 10-year note should have more risk than a 2-year note. How much more risk? They have a series of equations and assumptions that they figure out what the term premium is. So the orange line is what they expect that the fair value based on their term premium calculations is for the 10-year note. And the blue line is what it actually is. And the bottom panel is what we refer to as the term premium. Notice that from 2015 to 2020, it was negative, the red bars. Again, that was the abnormal period. That was the period of quantitative easing. This chart goes back to 1970, so it's got 53 years of data on it. The average term premium since 1970 was 1.68%. Where are we now in term premium? Slightly above zero. We're at an 8-year high. Oh, with term premiums at an 8-year high, it's too high because you're measuring it against the abnormal period. So when you sum all of this up, what do I think they're getting wrong? Two things. One, this is a different economy. This is not 2019 anymore. It's got more frictions as the labor market has changed, deglobalization, energy is a political weapon. Cheap energy is basically behind us. That is going to lead to higher structural inflation. That is going to lead to higher nominal growth. Two, all of these arguments about real rates and term premiums being too high, they're anchoring themselves to the QE period, saying that we're much higher than we were the previous 10 years. That previous 10 years was the outlier. What we're seeing now is a return to something that we used to see in a non-QE period. And so what we've got is some very average readings on a lot of these measures, not abnormally high readings on these measures. And so I think that that's what everybody's missing. Oh, but we have more debt and we have more leverage in the system. That's debatable. There is a lot of leverage in debt. I'm not disputing that. But more than we've seen in the past, that's debatable. Also, even if we did, all interest rates will do is they will approximate where nominal GDP is, and they will force the market to delever. The market won't say, oh, we can't handle higher rates because it might bankrupt everybody, so therefore they could never go up. They'll go up because of inflation and higher nominal growth, and they will force everybody else to adjust to their reality, not that interest rates have to adjust to the reality in the market. You hear this when people say the Fed can't raise rates anymore because interest costs will continue to go up. Yes, they can. And interest rates will continue to go up, and it will force Congress to do something about interest costs. It's not that Congress, by spending money like drunken sailors and saying if you raise interest rates, you're going to raise our interest costs, therefore interest rates can't go up. They've got that causation backwards. So I think when you sum it all up, all this bond bullishness is based on this idea that what was normal was that QE period of 2009 to 2020, and that we have to return to that period. And when they look at the inverted yield curve, and when they look at the level of interest rates, and when they look at the level of real rates or term premiums, they conclude that these are punishingly high rates and they're going to cause a recession, and it doesn't. Or they're going to break the back of inflation, and it doesn't. Why not? Because as nominal GDP moves up, because we have more inflation and more growth, the neutral rate, the fair value of interest rates moves up too. So let me put this in a different way. The Fed likes to say that their long-run inflation target is 2, and that means that their long-run funds rate target is 2.5. That's what they would refer to as neutral, 0.5% above the long-run inflation rate, 2.5. We're at 5.25 to 5.5, 300 basis points above that. So the conclusion is the Fed is very, very tight. I would actually argue to you that the long-run inflation rate is now 3. Maybe it's as high as 3.5, but let's go with 3. And that premium above the inflation rate of 50 basis points, that's what it was during the QE period. That premium should be more like 100 to 150 basis points. So you're looking at the fair value for the funds rate at somewhere between 4 and 5, depending on whether you want to use 3, 3.5 on the inflation rate, or 100 or 150 basis points on the compensation above the long-term inflation rate. 5 to 5.25 is restrictive. It's not 4 to 5. But all of a sudden, it's not that restrictive. So how does the economy able to shake off these higher rates? Because they're not that far out of line. The assumption with that there's 300 basis points of tightening is that 2009 to 2020 period was the normal period. It was not. We are returning to a non-QE period where we're going to return to much higher rates. I don't think this cycle is over. I've also argued that I think that the secular bull market in bonds ended in August 2020. That means we're in for several years of higher rates. That doesn't mean that every year is going to be higher. We'll have a 2 or 3 or 4 year period in the middle there where we might have a giant bond rally. But I think from low to high, the whole process is going to take many years. The point is, we got to start thinking about this stuff differently. The trap that the bond bulls have, I believe, is that they're looking at all these metrics through the prism of 2009 to 2020, thinking that was normal, this is too high, we have to go back to that period. We're not. The QE period is over. We're now going back to something that it looked like in the 70s or 80s or 90s, and that's why these rates, real rates and nominal GDP and everything, is actually not that far out of line. Rates are not that far out of line as much as everybody thinks.
Jim, thank you for your thoughts today, and thank you everyone for joining us. If you have any questions on Bianco Research, Arbor Research, or Arbor Data Science, you can contact us by emailing Gus Handler at gus.handler@arborresearch.com. Thanks again, and have a great day.